All right. Welcome, everybody, to the Tuesday edition of the Not Your Average Investor Show. Today, we're talking about an often requested subject on the show, which is how liquid are rental properties? Why would you sell them? What you have to do if you're going to do it? What are you going to put your money into if you do that? Right? All the concepts that you think about when you're thinking about exiting this asset class. I'm your host, Pablo Gonzalez. With me, as always, the man I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And also with us is our phenomenal community manager. We call her MTM because she brings us the moments that matter, because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
Good to have you on board. Good to have the community in the house. We've been having a lot of people showing up lately, GC.
It's been awesome, man.
160, 180 weeks. Pretty awesome.
Remember when this was just like a twinkle in our eyes and we had like 1, 2, 6 folks showing up?
Yeah.
Man, those were good days and these are good days.
It's been pretty wonderful. I think one of the things that our community is telling us that they like is our new attention in the YouTube channel.
Mm-hmm.
If you are only watching us live or listening on the podcast, I got to recommend, we've been doing every single week. We call them the golden nuggets.
Mm-hmm.
It's the moments of real learning from the show. They're usually 4 to 10-minute segments, but it's a good time. If you want to go in there, go to the JWB YouTube channel. You can either search for Not Your Average Investor Show on YouTube, or you can search for JWB Real Estate Capital on YouTube, but you get these bite-sized nuggets that you get to just take in, post-produced, all the fancy YouTube stuff. GC, have you been there recently?
I check it out all the time.
I bet you do.
You know I do. I see which one of the shorts are the highest performing shorts. We had over 1,200 views on one of the shorts you just did, which is pretty cool.
No big deal. No big deal. So check out that YouTube channel. If you haven't checked it out, subscribe to it, leave a comment, let us know you're there. I love to see the community comments in there. And for now, settle in and let's start our usual live show with what, GC?
The roll call, baby.
We got the MVP leading us off today.
Mr. Lee Bishop.
We got Christopher Lee from Fernandina Beach.
All right.
We got the legend of Virginia, Hall of Fame hockey player, has an arena named after himself.
Roger Voisenite. Good to see you, Roger.
That's legit legend, man.
100%.
Who else we got? We got Lita in the house. Lita Song in the house.
Coming a regular.
From Minnesota, right? MN?
Mm-hmm.
Minnesota, Minneapolis. Mm-hmm. All right. We got Mike McLeod from Pennsylvania in the house.
Mike.
All right, a lot of non-nickname folks checking in early.
Love that.
I like this. Earning those
new folks,
names.
but Mike's been a part of our
show. No, folks that are here, but just not.
I have to clarify. Mike's not new.
We got definitely somebody everybody knows. The fairy godmother in the house.
Jen Filzen,
wishing everybody a happy Labor Day weekend. We got John Evans from Michigan. New name?
Right. New name? I don't believe that's a new name. John's been here a few times, all right, John. But it's great to see you, John.
Good to see you, John, as well. We got Layla Powell in the house, teammate Layla. We got our regulars, the second family of the Not Your Average Investor Show, Gary and Rosalind Riley from Marietta, California.
We regard you.
We got the patron Santorios of the Not Your Average Investor Show community.
Michael Santorios.
We got the Mountain Man.
Billy Green.
Billy Green.
Funny thing, by the way, my kids love watching the TV show, and the main character's name in that TV show, Bill Green.
It's a phenomenal man. It's a phenomenal man. Who else we got? Our favorite fee-based fiduciary financial advisor,
Kelly Barenbaum.
Kelly Barenbaum in the house. Good to have you, Kelly. We got the ringmaster of the show,
Drew Barnhill. What is a lower alto, the ringmaster or
the ring
man, Billy Green?
Well, the ringmaster is lower. The mountain man is more
rustic.
I don't know, more rustic. We got Big Papa. We love when Big Papa calls in.
You need some water, man?
I got some.
Pops, how are you, man? Good to see you, buddy.
Greg's dad in the house. Love having him here. We got Darcy Laveau. We haven't seen Darcy in a while.
Darcy, longtime client as well. Great to see you, Darcy.
Good to have you in here, Darcy. Who else? We got Robert Jones. We're checking in with a happy
All right, Robert Jones.
Robert,
good to see you.
We got Marilyn Cotterman wishing us a hello from Homosassa, Florida.
So kind. That's the home of the manatees, Pablo.
I don't know how she catches the show hanging out with all these different manatees out there.
She's got a lot of manatee friends.
Good to have you back in the house, Marilyn. We got Hervé Francois with a what up, fam. Good to have you in the house, Hervé.
Good to see you, buddy.
Good to see you. We got Cody Adams in the house. Cody.
We
love Cody. The
special teammate
the
here.
The mama bear of the marketing team is what
you guys are going to get to know Cody very, very well here. She's going to be even more involved in the show and whatnot. She is so critical to the success on the marketing and the sales and the client service side for JWB. So give her a very big warm welcome.
Our favorite name to pronounce, Aaron O'Neill.
Into the light.
Good to have
Future
you,
star of the
Future
show,
star coming
Aaron
up.
O'Neill.
All about to see it. We got the first family of the Not Your Average Investor Show, the patriarch and matriarch, Ken and Carolyn Moline, with number one daughter, Duchess Cammie, last night, ready to come aboard.
Fantastic. We salute you.
We salute you.
My.
We got Karen Regal, Karen and Bob Regal.
All right. It's my business partners, Mama
There you
and
go.
Papa.
I love it when it's a family fair out here. We got Eddie Harris from Atlanta.
There we go.
We got Pop in the house.
Everett Shapiro.
Good to have you, Everett.
A lot of family connections here.
Sean Dockery in the house from Atlanta. Sean,
Love
good
that.
to have you here. This is great, man. Who else we got here? All right. Okay. Now we're repeating. Oh, we got Tony D. I see Tony D in the house.
It's not a party unless Tony D's here.
Tony D party in the house. We got Gina Kassan. Gina, that's a new name.
Love that new name.
Yeah,
All
welcome to the
right.
community.
Welcome
Good
to the
have you.
party.
Thanks for checking in. All right. Let's get this started, GC. We believe, or at least we get the feedback that folks get worried about this asset class because they think to themselves, if I'm going to go take this, lump of cash that I've worked real hard for and I'm going to invest it into a rental property, it is there, it's locked up, I don't have access to this thing. And that is, the value of liquidity or not liquidity is something we'll talk about later. But this idea that, you have very limited options based on having your money in rental properties in comparison to other assets.
Mm-hmm.
What do you say about that?
It's surprising to me. I wonder why that thought process is there, because when you think about it, right, there's a whole ecosystem. There's an entire industry devoted to making it easy for people to liquidate real estate. I see commercials from the National Association of Realtors all the time on TV, right? Like you drive down park benches, you see realtors, they're smiling faces and they're like, I'm here to make it easy for you to sell your property. I mean, clearly there's an entire network and an established industry regarding making selling real estate easy. And but at the same time, one reason or one question we may get when new clients come on board is, oh, geez, this all sounds really great, but I'm really worried about having to sell. How are we possibly going to do that? So I really wonder why. I guess I haven't really put my finger on why that might be one reason that people say to not invest in this asset class. Yeah. But I do think it's real. I'm glad we're having the opportunity to have the show on it today. Yeah. What I would say is, and we'll talk through some of the numbers and give you some perspective here, but at the end of the day, this is an asset class that can be sold. Yeah. There's a lot of professionals out there that are ready and willing and able and highly compensated to help you sell your home. And so it's certainly not a reason to not invest in this asset class. And maybe we can debunk some of the myths that folks have.
Let's get to debunking, my friend. Drew Barnhill's already saying he gets calls all day long about people trying to buy his properties. Me too.
Exactly.
Right? I think anybody that's invested in rental property in Jacksonville, Florida gets all the ghost callers. It's one of the downsides, right? Like your phone's ringing off the hook.
Unfortunately.
So that being said, I think there is a special level of concern right now, right? Because the headlines will tell you that home sales are going down, right? So does that make it difficult to sell a house? Before we just talk about the nuts and bolts, right now, this period of the economy, are the headlines steering us the right way? Is it true that it's harder right now to sell a rental property?
It's all about data and perspective. And to answer your question directly regarding the headlines, no, when they say that home sales are down, that does not mean that it is hard to sell your home. There is a very big difference there. Again, some of that is data without perspective. If they say home sales are down, well, home sales are down from a year ago. 100% they're down from a year ago. I'm not saying they're down 100%. I'm saying, yes, I agree with you fully that they're down from a year ago. And that's because sales were bonkers last year. If the pace of sales kept up with last year, we would have bigger problems in our country. So the fact that home sales are down is not surprising. We've talked about it openly here, how this was going to happen here on the show for over a year now. But that does not mean that it's hard to sell your home. And so I've got some great data to support this. So the best way to kind of measure how hard it is to sell your home is your median days on market. And what this means is you track all of the homes that sold in your market. We'll talk about Jacksonville, of course, but you track all the homes that sold in your market over the last month, and you track the median number of days for those homes to sell. And you can track this over time. And, if those days on market are way up compared to historical averages, then you would say, okay, it's harder to sell your home today than it was, at some point in the past, or if the days on market are lower today than they have been in the past, then you would say it's actually easier today.
Mhm.
So overall, it is not hard to sell this asset, but there are certain periods of time where you will have longer days on market and fewer days on market.
Okay.
So you want to hear some of the days on market?
Yeah.
Compare it, some data with a little bit of perspective sprinkled on here.
Sprinkle it on.
Let's sprinkle, baby. Okay. So right now, July 2023, the last data from the multiple listing service here in Jacksonville, 32 days on market is the median number of days that it takes for somebody to sell their house. Now, how does that feel to you? If it was the right move for you to make a decision to sell that property and you had to wait 32 days to sell your house, does that seem like that is an illiquid asset to you?
It doesn't sound too illiquid. I mean, I struggle to think if I know that I have something that's going to sell in the next 30, call it 40 days, and at that sum of money, I would assume that I have resources in order to bridge whatever gap it is.
You're certainly not going into that saying, oh my goodness, I don't know if that's ever going to sell. Gotta wait 30 days.
Correct.
Right? When you go and buy a property, you generally are waiting 30 days or maybe 45 days for the lender to do his part to close on the house. So you're waiting, 30 or 45 days to buy. Call it you're waiting 32 days on average in Jacksonville currently to sell your house. But I think the more interesting thing is right now, the feel for those out there is that it's really hard to sell. Well, let me give you a little bit of days on market in the past. Okay. Let's go back to 2020. Did you know that in July 2020, the median days on market was 41 here in Jacksonville?
Okay.
41. That's 30%-ish higher than what it is right now.
Yeah. And that was when stuff was flying
off the shelves.
Yeah.
Right. In July, right. Obviously, COVID happened. We needed a few months, but July 2020, things started really to escalate as far as home prices, and people were buying and interest rates were incredibly low. And there was this whole big news cycle about how everybody should invest in single family rental properties. 41 days on market in July 2020. July 2019, 39 days on market. July 2018, 36 days on market. July 2017, 41 days on market. So we're at 32 days on market right now, which is a lot lower than it has been recently. I went back to 2014. You often talk about how, man, if I could have a time machine, I'd go back to 2014 and I'd buy as much as I possibly could in Jacksonville real estate.
Everybody would here.
Yeah. You want to know what the days on market was in 2014?
What was days on market?
53 days on market in July 2014.
Okay.
53. Right?
Yeah.
And then I look back at the last time that there really was a hard market to sell a house in Jacksonville. And that would be July of 2011, right? July of 2011, we still weren't out of the woods yet for the Great Recession, and it was a tough time. I owned a lot of real estate there. I was buying and holding, but I will give you that. It was tougher to sell at that moment, probably the toughest it'll ever be in my career. This is what it looks like for a really, call it noticeably more difficult time to sell a house. 92 days on market is what it was in July of 2011. 3 times what it is right now. And that was more difficult to sell.
Yeah.
Right? But we're talking about 32 days on market right now in this environment. And home sales are still high compared to Jacksonville's historical averages. They're just lower than what they were a year ago. And that's not really the right way to look at this. So if you're on the sidelines and you're saying, hey, I love everything about this asset class. I want to take my money from the stock market. I want to put it into this asset class, but I just don't know. Am I ever going to be able to sell that property? Think about this. 32 days on market. That is not a reason for you to stay away from this asset class.
That's pretty eye-opening, man, because I would have thought when I was an average investor and I wasn't part of this community and I had purview to all this stuff, I bet you the common thinking is 90 days right now, right? Like I hear about people thinking that this asset class is so illiquid and it's so hard to get out of. I bet you people are thinking that it's like 2.5 months, 3 months to sell a property, as opposed to this idea of like a month. Yeah. And that's a completely different equation, right? So like, as far as liquidity goes, I think waiting 30 days to cool down on something is probably not a bad thing, right? Like reduces your impulse to like do impulsive things, makes you really think it through it. If you have a deal that you really want this like capital to get into and you're thinking about dropping that kind of capital, you're probably going to do 30 days of due diligence on it.
Probably.
You know, what is it that you really need 200 grand for tomorrow?
Exactly.
That isn't, you know, like that you shouldn't really think about, right? Like, so, okay, so that's a new perspective. All right. So 32 days on market. That's how long it's taking right now. If you absolutely have to cash out, you need that cash in your bank account for something. I think that's pretty eye-opening. We've got a couple of nuanced questions here, but before we get into the nuanced questions of like what could affect that number or the different considerations around the sale itself, let's talk about the process. I believe it's, Darcy Laveau is putting in here. I get mailers to buy our property also, like Drew mentioned, like we all do, but these are investors trying to lowball. My concern is if I want market value, how long and how close to market price can I expect in the existing market? Does JWB coordinate these efforts or do I need to locate my own realtor? So I think this is the overall question of like, all right, I just want to sell my house, retail. What needs to happen here, GC?
JWB is here to make this easy for you. Just like every other part of this investment decision, our value here is to make it easy for investors from the beginning of the moment that you start to reach out to our team to the moment that you are selling your property. We're here to make it easy for you. And so as far as your questions, how long and close to market price can you expect, right? Average days on market is 32. We can also track the percentage that the open market is receiving compared to their list price. I would imagine it's pretty darn close to what list price is right now. I don't have that number, but you know, folks are able to sell their homes in a relatively short amount of time for the price that they're expecting, and it can be done easily for you. And so that's a part of our service for you.
So describe that. What is that? What is making it easy for someone?
Well, I think it first starts with an understanding of what's right for the investor. So, you know, we're going to spend time with you, and that might be a phone call every month. That might be a phone call every quarter, usually not much longer than that. And we're going to be a big part of your financial portfolio. So we're going to understand the decision that might make sense for you to sell the asset compared to everything else that's going on in your portfolio. And, you know, for a lot of clients, when we sit down and they say, well, I might think about selling, we sit down and we say, well, let's analyze that. How does that make sense when we're doing this? What if we could solve that cash need for you and still have you retain that asset? So spend a lot of time there. Let's just say that we get to the point and we realize that it is the right thing for a client to sell.
And we're going to go back to those questions on this call. But right now, let's say it's the right thing to do to sell.
The right thing. So what we're going to do is we're going to match you with a real estate agent in our network who is going to be able to list that home for you. And we're going to try to get top dollar for you. It's just as simple as that. It's a network of agents that we have here that we have trusted for, probably over a decade now to liquidate our homes. And it's a small number of agents. It's not a huge, diverse network. We keep it very small, and we make sure that these agents have our clients' best interest at heart, that they can do what Darcy asked for. Can they sell it quickly, and can they get top dollar for it? Because at the end of the day, we want to be in a position to be able to overperform for your returns. And if we were to put you with an agent who sold it, who couldn't sell it, or who sold it for a discount to market value, ultimately, that makes it harder for us to produce the returns that we told you we were going to produce. Right. And so yeah, it's just painfully simple. We make a recommendation based on our network to somebody that we trust, who has shown over and over again to be able to deliver sales for top dollar in our neighborhoods, and we get the property sold for you.
Yeah. So like all things in the JWB vertical integration, passive nature of this experience, you find someone that's specialized, local here, that is specialized in this workforce housing stock here, can list it for you, knows the whole procedure, has done this a bunch of times, and gets it off market, you know, like gets it in someone else's hand and money in hand, and is able to just handle this thing for you, right? Oh, look at that. Perfect timing.
Sorry, I felt the frog in my throat coming up.
Yeah.
Yes, absolutely. And you might say, well, how do I have confidence that this person that you're going to put me with is able to deliver? In addition to the extensive experience and whatnot? Well, you know, our core focus is to help clients build a portfolio of rental properties, but JWB from time to time sells homes on the open market as well to retail buyers, to owner occupants. It's a relatively small portion of what we do and has been in our company history, but we sell some homes, not in our core neighborhoods. These might be homes out by the beach and whatnot. And who do you think we go to be able to sell the homes for our company? It's the same folks that I would be recommending for you to work with. And I wanted to share how our real estate team, our retail team is what we would call them, has been doing this year. Just give you some perspective. We sell 300 or 400 homes a year as far as turnkey rental properties. Many of you in the audience own these turnkey rental properties. Retail sales would be a smaller portion of it. The most we've ever sold in a year for retail sales was 81. This year alone, just to reinforce that this is still a hot market to sell a property on the open market, this year alone, we've sold 81 retail homes.
Okay.
This year.
Okay.
We have 117 that are under contract. And so this year is not done, of course, and we will break that record for JWB internally to selling homes to retail buyers, owner occupants on the open market. So hopefully that gives you confidence to know it can be done, it is being done, and the people who are selling those homes are the same people I'd be putting you in touch.
Interesting. Okay, cool. I'm going to go back to why you're selling these retail homes as part of this idea of why an investor would do it as well. But first, I want to clarify a couple things in the process because we have some good questions. MVP Lee, I know you've heard of him, and Roger Evans, both asking the same thing. Is it hard to sell a house with a tenant if the tenant does not want to buy the house? Like, does having a resident in place muddy up this procedure?
Yes, it does.
Okay.
But that's why we work with you months and years in advance to find the ideal time for you to be able to sell that house, right? Many times that's when the resident moves out. And then we have that coordinated effort for you. So then you can maximize the value of that lease. And then we put the home on the market. So you don't have that challenge, which is someone living in the home when you're trying to sell it.
Got it. So you are working ahead of the time with the investor because you have a portfolio manager, you know, people's goals and stuff like that. What is the process of like having a resident in your house? Like, let's say I'm not working with JWB. What would I need to be looking for?
Are you saying what's the process of selling the property with a resident in the home?
Correct. What would you have to like look out for?
I mean, it can be done. We do sell it sometimes on the open market, even with a resident living in place. So it can be done. It's more coordination. The buyer on the back end has to have more of a vision of what they are going to experience when they're living in the home rather than what they see from somebody else living in the home. So, when people buy homes on the open market, it's a very emotional process. So it makes it more difficult in the mind of the buyer. It's more coordination with the residents, more coordination with buyers who potentially want to see the home. Appraisals are more difficult because appraisers have a harder time of seeing the value of the home if somebody's leaving stuff around the house when they go to do the appraisals because somebody's living in it. So it's just more challenging, but it still can be done.
So elevated levels of coordination and maybe timeline. Like if I'm going to buy it for myself and somebody has a contract for the next 6 months, I need to be able to like buy this home and then move in 7 months later or something like that.
Yes, because the end buyer has to honor the lease with the resident living in there. And so if they are buying that in order to be able to live in it, they'll have to make their life plans based on that. So more challenging there as well.
Yeah. So a couple of extra challenges, but not things that you can't overcome, essentially, just more coordination.
And just normally, this is just not an issue. It's very rare that a client has some, overwhelming need to sell the house like right now.
Yep.
And that there's a resident that's going to be in that home for years. And I mean, the chances of that lining up, usually that doesn't happen. So with proper coordination, this usually is not an issue.
Got it. Okay. So then let's talk about the other thing that Michael Santoro says. I'm going to say that the fear of selling isn't the time it takes to sell. It's the unknown costs like fees, taxes, etc., like paying capital gains on the process. So I guess this now opens up the idea of like when, like things to consider before you actually sell, right? So you want to go through this a little bit?
Yeah. And, understanding the costs that come along with selling is really critical, not just to understand before you sell, but before you make that investment in the beginning. You got to understand what it's going to cost you to sell. Otherwise, you're not going to have a realistic expected return on investment. So whenever a new client comes on board, we're able to sit down and say, okay, well, these are the expected returns on investment for this pile of money that you're bringing to this asset class with JWB. And if we want to liquidate in 10 years or in 20 years or in 30 years, this is the expected cost that you should see when you liquidate. We take that out of the profits, and then we run the analysis based on your returns incurring those costs. So those unknown costs really don't need to be unknown. When you work with a vertically integrated provider like JWB, we know those costs. We lay it out for you. They're part of the initial expectation. And, as far as paying capital gains on the profit, obviously, now we're getting into tax planning and things of that nature. And so if you need help with tax planning, we'll make a recommendation for you to work with the same type of accounting teammates that we work with. And, most people's tax situation is not that complex when you own
Mhm.
3, 5, 10 rental properties. It's not that complex, but it's a good question to ask. And we can help, whether that is doing a 1031 exchange to where you defer the taxes that you would otherwise have to pay. So we're involved all the way throughout the process from the beginning to the end. We're here to give you that information. It doesn't have to be a fear.
Got it. So what I'm hearing from you is that there are tax implications and other costs that come into play. And I'm also hearing, number one, those things are accounted for in your investor packet, right? Like when I invest in my property, those numbers are already baked into it.
Yes.
I would assume that the timeline that I stay, right, those are baked into it for 10 years out, right? So if I stay beyond 10 years, then same costs, return's going to be a little bit better because it's been longer or not?
Well, we put some new bells and whistles since you saw that investor packet when you made the decision to invest. So actually we can analyze it over 10 years, 20 years, 30 years.
Okay.
So those costs are actually real based on the assumptions that generally stay true in real estate. And so, yeah, so it's built out for 10, 20 years, 30 years.
So that's already built in. And if I was to still move forward with it, it's resolvable, right? Like all these things are going to happen. You're facilitating all this stuff. I'm not going to be going in blind because you're supported by JWB. If I wasn't supported by JWB, I would want to have a team that is helping me through this thing to know kind of like what I need to hold back for taxes, how it's going to hit on this thing. You probably want a flat fee-based fiduciary financial advisor friend that's going to kind of give you the implications of these kinds of things. Now, that being said, GC, I think this is a good time to bring up the idea that sometimes based on these fees and based on these other things, you may want the cash and you may think that you want to sell, but maybe there's a reason not to sell. Do you want to talk about the different options that most people fail to realize when they're thinking that they need this cash instead of taking these hits?
Well, let me throw it back to you. So people do come and say, I need this cash, right? For some reason, right? What do you think the biggest reasons that they say that are? Like, what do you think is the biggest reason that people think they want to sell?
To make another investment.
To make another investment. Okay.
Or I'm running out of money and I need money to live on.
That's less likely for our clientele.
Okay.
Right. And that's a tougher one to solve. If it's immediate and you need cash to survive, we probably needed to do a better job of setting expectations before you got into this asset class. Okay. If you're finding yourself in a position like that. So let's put that one to the side because that's very, very unlikely.
All right. So it's a good time to sell.
It's a good time to sell. Why is it a good time to sell?
Because price has gone up a bunch and I want to cash out and I want to lock it in. Okay.
What are you going to do with that cash when you lock it in?
Probably make another investment.
Where are you going to put it?
Under my mattress. Buy gold, I just want to go into the stock market. Like I think, it's a good time to buy tech stocks because there's been a dip. I don't know.
Okay. So, this is a good line of questioning, and whatever the questioning leads to, it's good for that end person to know where their money is going to be sitting after you may invest, after you may sell, because you may find that you go to all of these lengths thinking that you want to sell this asset and wind up in a less good asset for your goals. So let's talk about the stock market, right? I just ran some stats over the weekend, and if folks are thinking about taking their money in real estate right now and putting it in the stock market, I just want to pump the brakes a little bit, because according to Vanguard, they believe that over the next market cycle, they're going to produce a 7% return in their typical 60-40 portfolio for their investors. And we can cite that article. I'll put it in the Facebook group after this, but that's according to their head of an investment analysis, and that's according to their financial simulation tool. So 7% is what Vanguard says they're going to earn on their money for their clients over the next full market cycle. Well, the assets that we have at JWB or in real estate in general can produce between 9 to 10% with relative ease. So if I know that we all just made a lot of money from appreciation, but if we're taking that money and then we're putting it into stocks and bonds in a portfolio like that, and the reason is to make more money over the long haul, you're probably not going to do that. So for most folks, taking money out of real estate and putting in the stock market's usually not what I'm hearing. When you start to add on some other things, a lot of people are actually taking money from the stock market and bringing it to real estate because they need to diversify. And then number two is they're concerned about how it's going to perform. The stock market's going to perform in a recession. So some stats. Since 1946, the stock market, the S&P 500 has had a dip of at least 10%, 41 times. I think there's only 77 years since 1946. So if you run the numbers, there's at least a 10% dip in the S&P 500, one out of every 1.7 years. Now I have some data from 1982 until right now, because that's the farthest that real estate data goes back. But there's been only 1 year in Jacksonville where home values dropped more than 10%. So if you're thinking about doing it because of you're going to make more money, you're going to take it to the stock market, that's probably not what's going to happen over the long haul. If you're thinking about doing it because you're
Preservation of capital.
It's probably, I mean, it's going to be a bumpy ride just based on historically what happens. We all know the stock market's more volatile. So we have some of these conversations. Why are we doing that? Let's understand it. And then if at the end of the day, if somebody has $0 in the stock market and they have all their wealth in real estate and they want to diversify the other way, then we're gonna encourage that because we want to be the best resource for you. It usually doesn't wind up that way. Another common thing that I'll hear is, oh, I want to sell this house. I want to go buy another one. I want to sell this property and let's talk through that. And I want to buy another one. Well, and if you are a member of our class, if you enroll in the class, you can go to notyouraverage.guide.com, right? We built this class, and one of the big tenets of this class is teaching people about these 5 profit centers. And these 5 profit centers get better with time. And every time you make a new investment, you get to enjoy these 5 profit centers, but you're resetting the clock on these 5 profit centers. So even though you made a lot of money from home price appreciation in your Jacksonville property right here, the chances that it makes sense for you to sell your Jacksonville property to go and buy another Jacksonville property is pretty slim, right? Because we believe that the home price appreciation for this property versus another JWB property is going to be very similar over the long haul anyway. So you're not getting a bump from that, and you're losing by selling. If you just held on to that asset, those 5 profit centers are working more for you for the one that you held on versus the new potential one that you would buy.
Yeah, you'd give up all that time in the game that's setting up that advantage.
Yes, exactly. Your net rental income is growing. So your cash flow has grown from the first moment that you bought, right? Your tax savings is growing because you now have more taxable income that is offset from depreciation. Your resident is paying down your principal more for you as you own these properties for a longer period of time. And you can count more on home price appreciation because it generally works over 10 to 20 year cycles. So you're getting closer and closer to being able to count on that as well as far as inflation hedging and inflation profiting. So every one of these is better for you to hold on. So usually selling to go to another property in Jacksonville doesn't make sense.
Okay.
Then I hear, well, maybe I want to sell this Jacksonville property. I want to go buy another property in another market. That could make sense, except for the fact that it's hard to find a market out there with a vertically integrated provider who can make this passive for you that has positive cash flow like Jacksonville and has higher long-term growth than Jacksonville does. And so generally speaking, and listen, there are exceptions to this line of thought here, but generally speaking, you're not going to find those 3 things in another market out there. So that's not to say that selling is the wrong move for a lot of people, but we need to investigate to make sure you're landing in the right spot versus just, oh my gosh, I saw a lot of appreciation. I just want to hold on to it.
Yeah. Let me summarize a little bit of what you said. Essentially, when you're thinking about it as an investor of taking the money you have invested in this asset class and moving it to another investment, you need to ask yourself the following questions. If you're moving it across a different asset class, you're going to ask yourself, well, am I doing this to make more from this investment, or am I doing this to lose less? And in general, workforce housing, rental properties in Jacksonville, Florida, make more than most other investments over the long term, normalized for risk, and are also more consistent and have a higher floor in general as well, right? So you're going to compare well to another asset class.
There's a million different investments out there, so I won't go that far to generalize more than every other investment.
But that's the question you need to ask.
But that's the question you need to ask. And when it comes to stocks and bonds, and it comes to other properties in Jacksonville, and it comes to other markets, generally speaking, the answer is to not sell. The answer is to generate that cash and hold on to the asset.
So then there's the other one of like, I want to go buy another investment property inside Jacksonville. And to that, it's, that's generally not the right answer because rental properties perform better with time and you're going to give up all the built-in advantages across the other 5 profit centers as well. But those are the questions that you want to ask yourself if you're thinking about it as an investor. Jim Kirkle's asking a solid question here. What about the people that say, I just got to pay for my daughter's wedding, or I have college I got to pay for, a medical or an epic trip? What about that, GC?
The beautiful thing about real estate and rental properties and what we believe in here is that you can access capital without selling the asset. You can access capital without selling the asset. You can't do this in the stock market, generally speaking, right? But in real estate, if we have a wedding or an epic trip or college for the kids, we can show you how you can hold on to the asset and still get that capital out of there.
Let's call it a $30,000 to $100,000 one-time expense for a lifestyle thing or like a thing that you need. You wouldn't have to sell the whole house in order to like come up with that money. There's other options
100%.
that tend to do better for you if you want to continue keeping all this time that you have in the asset. Talk to me about those, GC.
So, I mean, the one that is most, especially over the last couple of years, has been most relevant has been refinancing. Now, it's a little bit of a different equation today because interest rates are higher today than they were, 2 years ago. But we did show after show talking about how when folks hold on to properties for 5 years, maybe 10 years, somewhere along those lines, just based on historical appreciation, you're able to pull out $20,000, $40,000, $60,000 of capital out of your rental property and still own it. And it's still positive cash flow, but you were able to extract that profit so that you could go and pay for that wedding or the college for your kids or that epic trip. It's just a simple refinance and we can make it super, super simple for you. And for many people, you accomplish the goal of getting that capital out, but you also still maintain that income producing asset in your portfolio.
Explain the refinance to my friend that has never heard of what you're talking about right now.
Yeah. So you bought the house at $200,000 and it's now worth $300,000. So you go to the bank and the bank gives you a loan for 75% of the value of that property. So what's that? $225,000, right? So you bought the property for 200 and you put 25% down. So you owe 150 on it. And now you go to the bank. It went up in value after 5 or 10 years, and now it's worth 300. The bank gives you a loan for 225. You owe 150 on it, and there's some costs and whatnot in there. But let's just say that there's 60 grand of capital that you've now extracted from your asset. You've increased your return on investment, and now you have the capital to do what you would like. You could spend it on wedding trip or whatnot, or you could take that capital and reinvest it in another great asset, which I know is the plan that you have.
Correct.
To continue to build your portfolio out and basically use the house's money to be able to do it. So it's a strategy that's been around for decades and decades and decades. Banks love it. Investors love it. It's easy in rental properties. It's not easy in other asset classes.
Does it make a difference if it's, all right, so that is the refinance play. Does a HELOC work kind of the same way? That's another thing that people throw out there.
A HELOC is something that I think most people should have in their repertoire at all times. And the reason is because a HELOC is generally either no cost to set up or very low cost to set up. And it doesn't cost you money to have access to capital. So I have a home equity line of credit. I should probably explain that. HELOC stands for home equity line of credit. And all this is the bank believes in investing in real estate and lending on real estate so much that because you have equity in your home, they're going to give you a line of credit that you only pay interest when you use that line of credit. And so for most folks, I recommend getting access to a line of credit because generally speaking, we all have a lot of equity in our homes today. There's over $10 trillion of equity in Americans' homes today. So this is something that can be used when you see the right opportunity. And so now interest rates on home equity lines of credit are higher today because this is in relation to what the federal funds rate is. And as you've heard the Fed raise the federal funds rate, home equity line of credit interest rates are higher. I think my home equity line of credit interest rate is like 8% right now. So we need to sit down and say, if you're thinking about this being a part of your plan to invest in real estate, we need to sit down and say, okay, let's put this loan, right? This home equity line of credit, right? Let's say that we pull $50,000 to be able to buy your rental property. Let's see what that does to your internal rate of return. Let's see what it does to your cash flow and make sure that this makes sense compared to your alternatives of investing in the stock market. It's not one size fits all. It's harder to make home equity lines of credit make sense today than it did 2 years ago because interest rates were so low back in the day, but it could still work. It can still work for the right client. We just need to make sure that we're accomplishing the goals for cash flow first so that we don't go cash flow negative. And that's certainly possible even with using a home equity line of credit. And if anybody has any questions about this, my team would love to chat with you. You can go to chatwithjwb.com. We can build this entire analysis for you.
Yeah, there you go. And all right, so now we've talked about two different reasons that people would sell their rental property. One being for another investment out there. One being for a life situation that you want access to a pool of cash real quick, like a wedding, medical expenses, whatever. Peggy Garnett in the chat brings up a really good one. What if you're not happy with your property management company? Hers is not living up to what they promised. Is that a reason to sell a rental property?
I don't think so. I think you need to change the property management company if you can't get to a meeting of the minds on them living up to what they promised. But the point here is that your job as an investor is to acquire assets, to acquire great assets. And the earlier you can do that in your investing journey, the better. And you've put work into what it takes to acquire the asset. And so if something's not working out along the way, right? If the management company isn't working out and whatnot, right? You can make a change to that management company, but you don't have to throw away the hard work that you put in acquiring a good asset. So
this is assuming that there is a professional property management company in your market, right? Like if Peggy's in a market that doesn't have a vertically integrated company that's going to line objectives up with her, then it's a different equation.
Yes. I mean, I think a vertically integrated real property management company is the right route to go in whatever market you are. That's what's going to deliver better returns and a better experience for you. So I would still keep that standard, but I guess the main point here is just don't throw away the asset. Don't throw away all the hard work that you did for the asset just because you're having a poor experience with your property management company. Just
think through all these questions. Are you gonna go to a market that has higher upside and a better property management company? Then at that point, maybe you liquidate an asset to do that. If you're going to move to a market that has equal or less, then you're probably looking to hold on to the asset.
Yes, I think you need to make that decision based on the numbers.
Yes.
First. Let's run the scenario of where you're potentially moving this asset to. And let's also look for solutions to accomplish your goal of cash or capital with a lean towards holding on to the asset, because that is the critical thing.
All right. We've got 80 plus people on the call today, which is pretty awesome.
It's awesome.
I love having the community. They got a bunch of really great questions. Right before we get to these questions, GC, number one, I just want to say for like a detailed breakdown, right? Because we're going to answer these questions. They're going to be general. If you need some detailed advice, you have more specific stuff that you want to talk about, go to chatwithjwb.com. This is a perfect reason to talk to somebody on the team. You just book a call there, line it up and ask all the questions you have for your exact asset. Like Peggy's question, depending on where your property is, I think that's a good reason to go to chatwithjwb.com and just have somebody talk you through all of it and maybe help you figure out what a good property manager actually looks like and whatnot, right? Beyond that, I want to ask you one thing. When it comes to this asset in real estate versus others, right? Like I know that we get compared a lot to syndications. How does the liquidity of a rental property compare to the liquidity of a syndication?
Completely different. So syndications has become a big buzzword, especially over the last few years. And a lot of investors were attracted to it because of the passive nature of it. But with that passivity in syndications, you give up a tremendous amount of control. And so when you're talking about liquidating your assets, you do not have control to liquidate your assets when you're in a syndication. Syndications, generally what they do is they raise a bunch of money for usually a larger property, and they lock up your money for somewhere between maybe 5 to 7 years is what they put on their initial projections. But when you read the fine print, syndication operators have the ability to change that at any point in time. They don't have to get approval most of the time from any of the investors. So that can be 5 to 7 years, that can easily become 10 years. And you can't get your money back for many times. Even when they say, oh, listen, we have a redemption period, which means that, it might be a 5 or a 7 year lockup is what you invest in, but they may say, oh, well, after 2 years, give us 6 months of a heads up, and then we'll redeem the money for you. They can change that at any period of time. Ask me how I know, right? They can just say, you know what? You had your money with us for longer than 2 years, but we are now canceling redemptions. And so you give up an incredible amount of control when you put your money in a syndication. And the beautiful thing about our asset class is that you maintain control. You're able to be passive when you invest in single family rental properties with JWB, but you maintain control, right? At the end of the day, if you don't want to follow my advice and you want to sell this house, a year after you own it, I can't stop you. You can sell it. If you want to leave JWB property management and go somewhere else, I can't stop you, even though I find that's hard to believe that you can find another asset class and another vertically integrated provider that can support you. So, but the thing here is control. So it's a beautiful part of this asset class that you can get a lot of the benefits of passive investing without giving up control.
So if you've come to this call, if you're one of the 80 plus people that have come to this call, you probably value liquidity. You probably value, knowing that you have options for an exit. And what you're telling me essentially is, if that's you and you're debating whether to invest in rental properties or invest in syndications, you got way more options when it comes to rental properties.
And I don't hear enough people talking about the lockup periods of syndications. They just assume that it's going to go according to plan, and many syndications do not. And those 5-year timelines become 7, and those 5-year timelines become 10. And, the longer you wait, what also happens is those return projections that started out at 15%, they quickly become 8. Sometimes they become 5, so, and you're just putting all of your eggs in the basket of that provider, that syndication operator being able to perform, where, for JWB, you're putting your eggs in the basket that we can perform, but you still have control. Yeah. And that's really a great thing for you.
It's a big deal to think about. All right. So let's jam through some of these questions. Okay. So you're ready? Lee Bishop, the MVP, you may have heard of him. Does JWB keep all the inventory when they take over other management companies, even though the houses are not in the core neighborhood?
Yes.
Okay. Bet. Jim Kirko, Hall of Fame first baseman.
There we go.
If I were not an average investor, would it be an option to owner finance a sale? Is this something JWB could also guide us in? So Jim is saying, if he was a JWB investor, could he owner finance one of his properties if he wanted to sell it?
Well, again, going back to control, if you are dead set on doing something to sell your asset, JWB cannot stop you. So you can do anything when it comes to the asset that you own, which is incredible. So with that being said, now what we're talking about is another strategy for selling the house to be able to get max returns for the client. We've never had a client that sold their homes with owner financing. Usually doesn't make sense, because most of the time people are trying to sell the house because they want to see an infusion of capital for some reason. When you sell the house with owner financing, you are not receiving an infusion of capital. Typically, you are getting paid over time by the person who's buying the house from you. So if most people are trying to get an infusion of capital when they are trying to sell, and owner financing doesn't usually accomplish that, it's not very common. Although the basic theme of the call today would be, I can't stop you.
Can't stop you. All right. Beth Whitney's got a question. I think it's just a comment. All of my JWB rentals are in my retirement account. There may be a need to sell when I reach the required minimum distribution age. If the rental income does not reach that amount, I have many years before then.
Great answer. And, great comment there, right? There are things, and, my thoughts, in the setting right here are more general in nature to try to help the most people I can through this show. When you have a specific situation and Beth's already a client, we're going to sit down with you and we're going to map out your specific plan. And so required minimum distributions are something we need to take into account. Retirement accounts in general are things that we have to take into account, and we do that. And so we will have that plan set out for Beth. If you have any questions, Beth, just reach out to your portfolio manager and we'll start to do that if we haven't done that already.
All right. Our own boy, Hervé, Francois says, Greg, as appreciation provides the largest impact to total ROI, does it make sense to sell a property in your portfolio that is in a JWB neighborhood that doesn't have good appreciation rates and buy a property in a JWB neighborhood that has a stronger appreciation rate?
Simple answer here is no, because there's no data to support that over the long haul, there's a better appreciation rate in one JWB neighborhood versus another.
There you go. Cody copied Lita's question that was in the chat, but I think we asked it. Where the question was, is it better to refinance or HELOC to invest in another property?
This is a great time for us to sit down and run the numbers. The answer could be both of those. It could be a little bit of a home equity line of credit. It could be a little bit of a refinance. It could be a little bit of taking money out of the stock market and putting into this asset class. So we've got to sit down with you, Lita, and build it out for you. And I think that would be a great next step.
All right. Billy Green asks, as an expert investor, Greg, would you ever advise anyone to enter into a home equity agreement, HGA, whereby the lender does not collect until the sale of the property?
So home equity agreement, this is relatively new, but if I'm understanding this right, Bill, this is where the lender actually charges you better terms for the loan, but they take a piece of your equity at the end of the investment. This is a new loan product that has been coming out. I think it's interesting because it helps to solve the home affordability challenge that we have, because, you know, rates and terms are better than what you would find on the open market. But what are you giving up? You know, the reason that lenders are coming up with these strategies is because they're going to win too. And the lender's going to win a lot more when they take a piece of your long-term home price appreciation. So it's something that, you know, for our investors, it's not something that, you know, we're doing. I'm always open to the best return on investment, best risk-adjusted return on investment. So I don't know all of the details on what the loan products look like, but again, if you're curious about it, we have the tools, we can run the analysis, but it's not something that we're doing right now because the return on investment calculations just haven't made sense.
This is an easy one, so I'm just going to put it to the front. Matthew Stewart, welcome to the community. Matthew says, to defer taxes on a sale, can you facilitate a 1031 exchange?
Yes, absolutely.
Absolutely. You go to chatwithjwb.com if you got something like that coming up, because there's like real guidelines that you got to adhere to. Yes. So you want to get on a call with an expert as quickly as possible. Go to chatwithjwb, pick a date, and they'll talk you all the way through it, man. Robert Jones has something that is related to that. He says, I have heard that it can be good to sell a property after 8 to 10 years due to major maintenance issues like roof, HVAC, etc. may become an issue. What about that reason if you're planning to 1031 exchange it?
Yeah, you know, that's a common thing that people say, and I don't really buy into it, right? I think people discount the value and the additional return on investment that comes from all profit centers, right? If you take in totality all 5 profit centers and you total up how much more you're getting by holding on for the next 10 years versus the thought that you have that something else may break in your house over the next 2 years or 5 years or 10 years, you're going to find that you're going to win by holding on, because nobody knows when these things are going to break, right? You know, nobody has a crystal ball. So you're going to win more often than not by simply just holding on to that asset. But, you know, each year home values go up. Each year your rent prices go up. Each year you get better tax savings. Each year your principal pay down is higher by holding on. And each year your inflation hedging and your inflation profiting is better for you. So, you know, I'm a little bit different than a lot of other folks out there, but I own a lot more properties than a lot of other folks out there too. So I think you buy and hold. And you know what? Maintenance costs are going to come and go, and they're going to be right in line with the historical estimations are over the long haul.
So what I'm hearing in what you're saying there, GC, is like, yeah, okay, you might think that, all right, it's been 8 to 10 years. I haven't had an HVAC break. It's going to break somewhere between in the next like 2 to 5 years. So cash out and whatever. But if you were to, you know, cash out so that you don't have to deal with that, right? But if I was to summarize our entire call, you're cashing out and then you got to go find another investment that you're likely not going to have the already advantage built in. If you've been holding for 10 years, you're already kind of like at a higher cash flow for your rental property. You've had appreciation already. Your debt started to get paid down, right? So like A, you would lose, that's already happening, and you'd have to go find another investment. B, everything that we talked about liquidating a rental property versus taking money out to do something, you can use that to pay for this repair, right? So the money wouldn't have to come out of your pocket, and you get to sit in the game for the next, like, let's say it happens in 2 or 5 years. You get to sit in the next 2 to 5 years of appreciation and tax benefits and debt pay down and the cash flow that you're getting. to then refinance to pay for this thing the same way. It wouldn't have to come out of pocket. So you have options to pay for it if you don't want to take it out of pocket.
Yes.
So essentially it's like an errant kind of like philosophy.
Yeah. I just wrote down.
That's the other thing is the other thing is if you also happen to be a JWB investor, your portfolio manager is going to coordinate that whole thing for you, right? So like
when that happens, it's going to be done for you.
You're not going to have to be playing general contractor in your own home if you're investing with JWB, because that is your portfolio manager's job, is just to be like, handle that stuff, send you a couple things to sign, cut a check, and you're done with it. So it's not a quality of life thing.
And you take that off the table, and then you could just make the best return on investment decisions.
Yeah.
I just wrote down, let's actually do a case study where we show, call it after the 10-year mark, how much you're earning in each profit center for like the next, call it 5 years.
I love it.
Right. And then compare that to the overall return, like the total up the return versus what do you think is going to break, and I'll show you how holding on will create more money for you than the $3,500 you had to spend on that.
Does that sound like a good show, family? If we talk about, does it make sense to sell a home after 10 to 12 years so that you prevent these like maintenance expenses? I think that's a great show.
Cool.
That's a great show. All right. Excuse me. Right along, Raj. Good to have you here, buddy. Has a question or two. I'm not sure if this is a compounding question or not. Land values are declining in some cities. Do you see a similar trend in Jacksonville? Nope. I mean to say, do you see similar trends? Are the home sites less expensive as compared to early 2022?
No. Values are going up.
Okay. Raj also asked, container costs from China to USA have come down drastically in the last few months. Do you see any relief with the cost of construction happening?
No, unfortunately.
Okay. And now we got BJ McKay. BJ, good to have you back in the house as well. He's asking, all dude BJ McKay, right? You remember that one?
Yeah.
All dude BJ McKay is in the house. Greg, do you see an average of 2 out of 12 months rent income going towards maintenance? Thanks, BJ.
Yeah, so I think what BJ is referencing is our expectations for maintenance costs. And I would imagine maintenance cost and vacancy cost. And so, if you're on our portfolio planning tool, everybody who comes through that we're able to build these portfolios for, we're going to break down, and we have expectations for maintenance costs they'll range between 4% to 7.5% of the rents that are collected. And so that is based on historically what we see across all 3,000 plus properties that we analyze month in and month out. So I haven't run the numbers right off the top of my head there, but yes, I would imagine that's what you're referencing, and that's what we're seeing.
All right. One more quick question for Jim Kirko. I don't know if I like this question. Do the Gators have any chance of winning a football game this year? Asking for a friend.
Hey, listen, he's in the Hall of Fame, so he can throw some shade. Okay. That was a tough go for the Gators.
I put the over under at half a game.
Here's my thought. I think we're gonna still overperform. I mean, people are only expecting us to win 5.5 games this year.
Yeah.
I think we're gonna still win more than that, but it's not. The fact that I'm saying that is like my big stand as being a Gator fan is just hard to stomach.
Yeah, Lee says I can never wear that tie again. I agree with you, Lee. I'll take full responsibility. And yes, Drew, the Knowles look incredible.
Yeah,
I am really jealous of that. Yeah. All right, Kemmerly, how do you win half a game? You don't, Jim. You bet the under if you don't think we can win half a game.
Pablo, I'm going over.
Yeah, I'm going to bet the over too. I'm not going to cheer for 0 wins. Ken Lillian asks, if you are concerned with a major expense coming up too soon, does it make sense to alert your property manager that at the next property turn, you want to proactively replace a roof or an AC unit or a dishwasher, et cetera?
I mean, it would be surprising to me that you would have that knowledge or that concern, that if it's based on things, based on facts and whatnot, it'd be surprising to me that you are bringing that to JWB. Now, sometimes people have a feel and emotion and they say, oh, well, I want to do this because I think it's going to happen. That's different. Sometimes we get that. But this whole thing is built so that we know about your portfolio and we come with suggestions to you to better deliver a return on investment. So it would be surprising if that was the case. What would most likely happen is if there was something that we were aware of that could break in the coming years, we're going to let you know as early as we can. And it might say, on our scopes of work, we have items that must be addressed And then if there are items that may or may not need to be addressed, that's a different section of the scope of work. And we say that this is optional, but we want you to plan for this for cash flow purposes, because it's likely at some point in the next few years or whatnot that this is going to go bad. So long-winded way of saying, Ken, we should be doing that for you rather than you bringing that to us. And we're just going to ask you to make decisions based on numbers rather than like the fear or the emotion that this may go out. I mean, we're here in Jacksonville. We just, took possession of the home in many cases. We just inspected these different parts of the house. And so if we look at it and we say that it's good to go, even though it's been, it's a roof that's been on for 10 years, we're not going to suggest that you fix it just because of feel.
Got it. Always using data. Last one, Robert Jones. The insurance companies are being most picky about maintenance issues, especially about how many years a roof, et cetera, is.
Yeah, good point. That's the state of things. Insurance companies are really, they have been reeling for the last few years. We believe that the worst is in the past, and we hope that the insurance market will settle down a little bit. The thoughts are that it has, and that, it'll get a little bit easier for all of us to manage going forward. But, insurance overall, it's one input for an overall good decision, and insurance costs are higher today and a little bit more tricky to do what they say we need to fix on homes than we all would like. But at the end of the day, that's one input, and don't let that, otherwise sway you from a really great decision just because that's a little bit more of a hot button item. At the end of the day, our returns are better, including these higher insurance costs, than a lot of the other alternatives.
Right. Sounds good. GC. Good show today, buddy.
This is great, man. Thanks for bringing this one up.
Yeah, really good time. I didn't bring it up. The community brought it up, man.
Oh, I thought you did.
No, man. This is just one of the things when the community sends in a topic.
Yeah, you're right.
We do a topic and they always respond. 80 plus folks showing up. You are what makes the show special. Your ability to bring us questions, right? Whether it's emailing it to us, whether it's going to our Facebook group at jwbfacebookgroup.com, posting it in there, or, even bringing it up on the show. We're always taking in these data points, and we know that when we bring in a topic that you're interested in, you show up, and that makes us happy.
It's pretty awesome.
So shout out to the community for this. I never take it for granted that you take an hour of a Tuesday to be here with us, to add this value, to connect with each other. I saw that Danette and Lee are planning a phone call in the chat.
No way.
People making friends, great inputs all the way around. Thank you so much for being here. This Thursday, we're doing what we now do on Thursdays. We look for a problem to solve, and we solve it via a portfolio of the week. GC, any teaser about what's coming up?
I haven't even figured it out yet.
I knew you hadn't, and I thought maybe you would just be like, the teaser is going to be, it's really good.
It's going to be awesome.
You're too honest.
It's going to be, no, this is actually what I do every week. I sit down and, a day or two before, and I'm like, okay, well, what's the most pressing? What have I heard from the sales team and whatnot? And, the last few have just had a great response because I think they were so real and tangible. So we'll come up with something like that in the next day or so, and we'll see you on Thursday for the show.
All right. We're going to see you on Thursday. But until then, one piece of advice. Don't be average. See ya.